Good evening, ladies and gentlemen, and welcome to the 367th actual meeting in the 94th year of the Economic Club of New York. As chairman of the club, it is my honor and privilege to present this evening's very special guest, the Honorable Alan Greenspan, chairman of the board of the Federal Reserve System. In his 14 years as Fed chairman, Alan Greenspan has demonstrated exceptional poise, expertise, and confidence in guiding the U.S. economy. Chairman Greenspan's leadership has helped to produce the longest period of economic expansion in our nation's history, a higher standard of living for all Americans, and a U.S. economy that is the epicenter of the global economy. A native New Yorker, he earned his undergraduate, master's, and doctoral degrees from New York University, where he taught from 1953 to 1955. He served as chairman of President Ford's Council of Economic Advisors and as chairman of the National Commission on Social Security Reform under President Ronald Reagan. President Reagan then appointed Alan to his current position in August of 1987. 2 months later, during the market crisis of October, Alan demonstrated his great skill and leadership by ensuring liquidity was returned to the markets and investors could weather the most severe market downturn since 1929. He has been reappointed by Presidents George H.W. Bush and twice by President Bill Clinton. In the months prior to his most recent renomination, the most frequently asked question among those who follow markets was, will Alan Greenspan stay on? Fortunately for all, he did. By the time his current term is completed, June of 2004, he will be the second longest serving chairman in the Fed's history. During his tenure over these past 14 years, the Dow Jones Industrial Average has grown fourfold. The number of individual Americans owning equity securities has more than doubled to 85 million. Average daily volume on the exchange I most watch has gone from a mere 150 million shares to 1.2 billion shares, and most importantly, and I thank you, Mr. Chairman, the value of the New York Stock Exchange's global cap has risen from $1.5 to almost $18 trillion. Alan Greenspan deserves praise for his leadership and service to America and to all Americans, and for his ongoing and loyal commitment to this club. With this evening's address, Chairman Greenspan becomes the club's first 6-time speaker in its 94-year history. But for that matter, but I must say, he also is the club's only 5, 4, and 3-time speaker in our 367 meetings. Ladies and gentlemen, it is my honor and privilege to present the extraordinary leader of the Federal Reserve, the Honorable Alan Greenspan. Chairman?
Thank you very much, Mr. Chairman. It struck me as you were indicating my 6th, 5th, 4th, 3rd ranking that all others apparently learned far more quickly than I that this is not the place you come to, because it's tough, and it is tough, and that's what makes it great. in any event, I'm delighted to be here again, and I figured that when I used to come previous times, as Dick indicated to me over dinner, that I used to be terribly concerned that I would be inadvertently clear. The trouble is, after 4 or 5 times, I noticed people there with little Fed-speak dictionaries, and they had the obvious capability of cutting through some of the obscurity of which I have become well-versed, I believe. So tonight I'm going to do something quite different. I'm going to speak very clearly, and no one will have a clue what I said. As I've indicated over the most recent years, it's been an extraordinary economy with which we have been dealing. The past decade specifically has been just about as extraordinary as any I recall in the years I've been observing the American economy on a day-by-day basis, and that goes back more than 50 years. The synergies of key technologies markedly elevated prospective rates of return over the last decade, mainly, of course, on high-tech investments. It's led to a surge in business capital spending and significantly increased the underlying growth rate of productivity, as you all know. The capitalization of those higher expected returns boosted equity prices, contributing to a substantial pickup in household spending on a broad range of goods and services, especially on new homes and durable goods. This increase in spending exceeded even that of the enhanced rise in real incomes. By early 2000, the surge in household and business spending had lifted the growth of the stocks of many types of consumer durables and business capital equipment to rates that could not be continued. The elevated level of light vehicle sales, for example, implied a rate of increase in the number of vehicles on the road hardly sustainable for a mature industry. And even though demand for a number of high-tech products was doubling or tripling annually, in some cases new supply was coming on even faster. Overall, capacity in high-tech manufacturing industries rose nearly 50% last year, well in excess of its already rapid rate of increase over the previous 3 years. Hence, a temporary glut in these industries and falling prospective rates of return were inevitable at some point. Clearly, some slowing in the pace of spending was necessary and expected if the economy was to progress along a more balanced growth path. But the adjustment has occurred much faster than most businesses anticipated, with the slowdown likely intensified by the rise in the cost of energy that has drained businesses and households of purchasing power. Growth of outlays of consumer durable goods slowed in the middle of last year, and shipments of capital equipment, excluding aircraft, have declined since late in the year. Moreover, weakness emerged more recently among our trading partners in Europe, Asia, and Latin America. The interaction of these developments has led to a broader softening than each of the individual economies would have experienced on its own. Because the extent of the slowdown was not anticipated by businesses, it induced some backup in inventories, especially in the United States. More advanced supply chain management and flexible manufacturing technologies have enabled our firms in recent years to adjust production levels more rapidly to changes in sales. But apparently, these improvements have not yet solved the thornier problem of anticipating demand. In the event, inventory sales ratios rose only moderately, but relative to desired levels, at least as inferred from their downtrend over the past decade, these ratios implied that considerable imbalances had emerged. Confirming this impression, manufacturing purchasing managers reported that inventories in the hands of their customers had risen to excessively high levels. As a result, a round of inventory rebalancing took hold, and the slowdown in the economy that began in the middle of 2000 intensified. The adjustment process began late last year when manufacturers cut output sharply to stem the accumulation of unwanted inventories. As output declined further, liquidation apparently took hold early this year in a number of sectors. Much of the inventory reduction in the first quarter reflected a dramatic scaling back of motor vehicle assemblies, which removed excess cars and light trucks from dealer showrooms and lots. By the end of March, the inventory of cars and trucks had fallen to a more satisfactory 61 days supply, though some uptick in light truck inventories was apparent last month. Inventories of computers, semiconductors, and communication products also backed up, and by contrast, these stocks are only belatedly being brought under control. Inventories of semiconductors and computers have fallen, but less progress appears to have been made with respect to communications equipment. Overall, inventory investment of high-tech producers has probably turned negative, but a period of substantial liquidation still appears ahead for these products. For all inventories, the rate of liquidation appears to have increased this winter, and limited data suggest that it has remained sizable this spring. Although a not inconsequential proportion of the current liquidation undoubtedly is of imported products and thus will presumably affect foreign production, much of the adjustment has fallen on domestic producers. At some point, inventory liquidation will come to an end, and its termination will boost production and promote recovery. Of course, the timing and force with which that process plays out will depend on the behavior of final demand. In that regard, consumer spending has been soft, but seems for the moment at least not unduly so. The demand for capital equipment, however, is more problematic. Despite evidence that expected rates of return on the newer technologies remains high, investment in equipment and software has slowed. As I already noted, some adjustment from the earlier unsustainable pace of capital accumulation was inevitable. But the weakening appears to have gone beyond this adjustment, reflecting a deterioration in short-term profitability and cash flow. Pressures on profit margins and cash flows have been unrelenting. The earnings estimates of security analysts for the S&P 500 in 2001, which presumably reflect the guidance that these analysts are getting from corporate management, have been revised downward by nearly 1% per week since February. To be sure, the pace of downward revision has slowed this month, but the adjustments remain negative. Earnings weakness is evident pretty much across the board, but especially for high-tech firms, where the previous extraordinary pace of expansion has left oversupply in its wake. Much of the profit squeeze results from a rise in unit labor costs. Gains in compensation per hour picked up over the past year, responding to a long period of very tight labor markets and the effects of an energy-induced run-up in consumer prices. Faster increases in hourly compensation, coupled with the cyclical slowdown in the growth of output per hour, have elevated the rate of increase in unit labor costs. In effect, fixed costs, both labor and non-labor, are being spread over a smaller production base for many industries. The sharp rise in energy costs has also pressed down directly on profit margins, especially in the fourth and first quarters. A substantial portion of the rise in total costs of non-financial, non-energy corporations between the second quarter of last year and the first quarter of this year reflected the increase in energy costs. Prices paid for natural gas and petroleum products by these corporations continue to rise into the first quarter, but have eased this spring. Electric power prices, however, continue to rise sharply through last month. Going forward, the prospect for higher electricity costs is most pronounced, of course, in California. The rise in natural gas prices last quarter contributed directly and indirectly through its effect on the cost of electrical power generation, much of the rise in overall energy costs for non-financial, non-energy corporations. Because we import little natural gas, higher prices largely result in a transfer of income from natural gas users in the United States to American natural gas producers. Nonetheless, these higher prices are likely to weigh on the economy in the short run because the increase in capital spending by energy producers is unlikely to offset the drag on spending by energy consumers. If overall final demand holds up reasonably well, the rate of inventory liquidation must begin to slow as inventory levels shrink towards operational targets. Production and imports taken together would rise towards the level of final sales as inventories are brought into the desired alignment with sales. In the past, such episodes with their associated increases in employment, household incomes, and profits would engender a cycle of expansion, including a pickup in investment. While such a scenario is likely to develop at some point in the period ahead, there are nonetheless considerable uncertainties about its timing and magnitude. Even after its recent decline, overall investment in equipment and software remains sufficiently elevated to be able to contract further for a time and still maintain an impressive uptrend in capital accumulation. Despite the marked softening in the flow of new orders into high-tech manufacturing firms in recent months, the level of these bookings was still higher than in early 1999, a period of emerging euphoria. Indeed, at the end of March, the level of unfilled orders for domestic establishments producing computers and communication equipment was still close to a record high, though unfilled orders for producers of electronic components, while still elevated, were well off their peaks. These data, of course, include a number of the large established firms whose experience has not been as adverse as that of the more visible recent high flyers. Whether the well-advanced inventory cycle provides support for recovery or whether a further weakening of investment and consumption demand undercuts that support should become increasingly evident in the weeks and months ahead. The persuasive evidence that the growth of structural productivity remains well maintained and that prospective long-term rates of return probably have been only marginally diminished suggests a solid underpinning to capital spending. At some point, one hopes sooner rather than later, the high-tech correction will abate and this set of industries will reestablish itself as a solidly expanding, though less frenetic part of our economy. At that point, rather than returning to the outsized 50% annual growth rates of last year, a more sustainable pace should be expected. Of course, investment demands ultimately depend on the strength of the consumer markets for goods and services. Here, too, longer-run advances in real income and spending resulting from an acceleration of productivity and real wages should provide support over time. But there are also downside risks to consumer spending over the next few quarters. Importantly, the same downward pressure on profits and the heightened sense of risk that have restrained investment have also lowered equity prices and reduced household wealth. We can expect the decline in wealth that has occurred over the past year to restrain household spending relative to the growth of income, just as the previous increase gave an extra boost to household demand. Furthermore, most survey measures suggest consumer sentiment, while having stabilized recently, remains fragile. More recent concerns have arisen with respect to possible effects of higher gasoline prices on the economy. A rise in these prices this summer, as many fear, would, as always, act as a tax on households' incomes and spending, hardly welcome in today's context. However, while wholesale and retail prices for gasoline have surged in recent months, crude prices have not, apparently owing to a shortage of operating refining capacity in the United States. Gross refining margins have widened by about 20 cents per gallon, seasonally adjusted, since February. With some temporarily closed refining capacity coming back online, and with higher gasoline prices likely to curb consumption and draw in product imports, market forces seem to be poised to contain further price increases at the pump. Presumably, this is the reason that gasoline prices for future wholesale delivery are well below current elevated levels. The economic developments of the last couple of years have been a particular challenge for monetary policy. Once the financial crises of late 1998 that followed the Russian default eased, efforts to address Y2K problems and growing optimism, if not euphoria, about profit opportunities produced a surge in investment, particularly in high-tech equipment and software. This upswing outstripped what we could finance on a sustainable basis from ongoing domestic saving and funds we could attract from abroad. The shortfall of saving to finance investment showed through in a significant rise in average real long-term corporate interest rates starting in early 1999. By June of that year, it was evident to the Federal Open Market Committee that to continue to hold the funds rate at the then prevailing level of 4.75% in the face of rising real long-term corporate rates would have required a major infusion of liquidity. This would have added fuel to an economy that was already threatening to overheat. In fact, the 175 basis point increase in our target federal funds rate through May of 2000 barely slowed the expansion of liquidity, judging from the growth in M2 money supply, which declined only modestly through the tightening period. By summer of last year, it was finally becoming apparent that the growth of demand was slowing, and its evident excess over the growth of potential supply, as proxied by a diminishing pool of available labor, was being contained. Nominal and real long-term corporate rates eased off somewhat in June and July, and then were stable until much later in the year. This stability suggested that a rough balance between investment and saving plans were being foreseen by the markets. To have disturbed that balance with a decline in the targeted federal funds rate at that time, in our judgment, would have risked cutting short the adjustment needed to sustain long-term economic growth. Had we moved the funds rate lower at the first sign of economic slowing, we would have created distortions threatening an even greater economic adjustment at a later date. It was well into the autumn before one could be more confident that the balance of desired investment and saving was being durably restored. Even as late as mid-November, futures rates on federal funds and euro-dollar deposits indicated that the money market did not expect, or apparently see as necessary, a significant change in policy over coming months. Only in late November and early December did expected near-term federal funds rates finally slip noticeably under the prevailing 6.5% rate, arbitraging other short-term rates downward. By our December meeting, the Federal Open Market Committee decided that the time to press against cumulative economic weakness probably had arrived. We altered our assessment of the risks to the economy, and with incoming information following the meeting continuing to be downbeat, we took our first easing action on January 3rd. Owing to the evident accelerated pace of economic adjustment, largely a consequence of the technology-enhanced speed and volume of information flows, we have quickened our pace of policy adjustment this year. Last week, we lowered the federal funds rate, as you know, to 4%, 250 basis points below its level at the turn of the year. As many commentators have observed, the yield curve has steepened appreciably since the beginning of the year, and especially since mid-March. How does one read this market behavior? Is the steepening wholly a reflection of an expected firming in economic activity, or are rising inflation expectations lurking in the figures? In the case of corporate yields, much of the steepening, including the most recent uptilt, reflects a fall in short-term rates, such as those on commercial paper. Nominal BBB 10-year yields fell slightly through mid-March and have risen only modestly since then. The Treasury yield curve, however, has steepened more appreciably of late, as 10-year rates, for example, rose by somewhat more than corporate rates. The outsized increase in Treasury long-term yields relative to private yields probably reflect some expectation that the decline in the supplies of outstanding marketable Treasury debt may not be as dramatic as earlier thought. Still, the spreads between rates on nominal 10-year Treasury notes and inflation-indexed 10-year maturities has risen about a half a percentage point since mid-March, not an insignificant change. Interestingly, despite some apparent deterioration in actual and expected CPI inflation, there has been little acceleration in the broader index of core personal consumption expenditure prices. In that regard, the lack of pricing power reported overwhelmingly by business people underscores an absence of inflationary zest. Undoubtedly, businesses are feeling the effects of diminished pressures in product markets, with energy inflation probably peaking and the easing of tightness in labor markets expected to damp wage increases. Prices seem likely to be contained. We have often pointed out before to the essential role that low inflation expectations play in containing price pressures and promoting growth. Any evident tendency in financial markets or in household and business attitudes for such expectations to trend higher would need to factor importantly into our policy decisions. Forecasts of the suppression or reemergence of inflation, like all forecasts, do not have an enviable record. Faced with this inevitable uncertainty, a central bank's vigilance against inflation is more than a monetary policy cliché. It is, of course, the way we fulfill our ultimate mandate to promote maximum sustainable growth. A central bank can contain inflation over time under most circumstances. But do we have the capability to eliminate booms and busts? Can fiscal and monetary policy acting at their optimum eliminate the business cycle, as some of the more optimistic followers of John Maynard Keynes seemed to believe several decades ago? The answer, in my judgment, is no, because there is no tool to change human nature or to predict human behavior with great confidence. History suggests that risk premiums fall as the perceived threat of an economic downturn progressively fades. The longer an economy expands at a solid rate, the more people are likely to project that rate forward, eroding previous caution. This is a perfectly rational response. If people were accustomed to a 3-year business cycle, they would exhibit far greater caution going into the 3rd year of an expansion than if their normal experiences tended more to 10-year cycles. The dimensions of any expansion, of course, will be significantly affected by technological trends, wholly independent of people's evaluation of risk. And variations in technology and risk will appropriately affect asset prices to allocate capital efficiently in a market system. But on occasion, asset prices can vary by more than can be attributed to underlying fundamentals. As risk premiums fall in an expansion, asset values and capital investment tend to be boosted. The economy experiences additional impetus, remembrances of recession fade, and risk premiums fall still further, sometimes to levels below any credible justification. There is, of course, a downside limit, somewhat above zero, where declines in risk premiums end. At that point, confidence ceases to expand, inducing at least a momentary period of stability. Economic stability, not at all a bad state, is nonetheless less ebullient than the one that had existed as risk premiums were falling. Asset prices lose their upside potential and come under downward pressure as investors reevaluate risk and revise expectations for outsized gains. Monetary policy as we currently practice it endeavors to lean against the propensities for economic overshooting from whatever source by changing interest rates. But we are unlikely ever to be entirely successful. For example, it is not possible to foresee how far risk premiums will fall or when that decline will stop and reverse. Risk premiums cannot move ever lower, and the end of the decline will adversely alter psychology. A bursting speculative bubble has historically too often been the end result of this process. As I've indicated on previous occasions, identifying bubbles and their ultimate demise is exceptionally difficult. Indeed, as I already noted, movements in asset prices most often reflect changing underlying fundamentals. Forecasts that an increase in an asset price is a bubble would likely run counter to the conventional wisdom of a large segment of the investment community, or asset prices would not be so high. Policy cannot fully anticipate the buildup or the ending of speculative excesses. Indeed, were we to lower overnight rates in advance of an expected break in asset prices, we would presumably only exacerbate the economic and financial imbalances. Our only realistic alternative is to lean against the economic pressures that may accompany a rise in asset prices, bubble or not, and address forcefully the consequences of a sharp deflation of asset prices. While we are limited in our ability to anticipate and act on asset price bubbles, expectations about future economic developments overall inevitably play a crucial role in our policymaking. If we only react to past or current developments, lags in the effects of monetary policy could end up destabilizing the economy, as history has amply shown. Because accurate point forecasts are extraordinarily difficult to fashion, we are forced also to consider the probability distribution of possible economic outcomes. Against these distributions, we endeavor to judge the consequences of various alternative policy scenarios, especially the consequences of a policy mistake. The center of the forecast distribution of necessity is still important to our deliberations, but more than many people realize, policy making is to a substantial extent focused on the potential deviations from the central forecast and the costs should those outcomes prevail. In short, our policy behavior is the result of examining the implications of the interaction of probability distributions and loss functions. We do not engage in the formal mathematics of such a model, of course, but we do follow its underlying philosophy. While we are constantly exploring ways to improve our policy procedures, we do believe our current regime has served us well to date. In reducing the federal funds rate this year by 250 basis points in a compressed period, we have been responding to our judgment that a good part of the weakening of demand was likely to persist for a while, and that there were significant downside risks even to a weaker central tendency forecast. Moreover, with inflation low and likely to be contained, the main threat to satisfactory economic performance appeared to come from excessive weakness in activity. So we took out the restraint inherent in our previous policy stance and have moved policy to a more accommodative posture to counter the effects of the downshift in demand. As a consequence, some of the stringent financial conditions evident late last year have been eased. Real interest rates are down substantially in a wide variety of borrowing instruments. Private rates have benefited from a narrowing of risk premiums in many markets, like those for riskier commercial paper and high-yield bonds. And the growth of liquidity, as measured by M2, has picked up. Owing to the variable and long lags of monetary policy, the effect of our recent policy initiatives will take time to strengthen financial portfolios and spill over into demand for goods and services. The period of subpar economic growth is not yet over, and we are not free of the risk that economic weakness will be greater than currently anticipated, requiring further policy response. But we also need to be aware that our front-loaded policy actions this year should be providing substantial support for a strengthening of economic activity later this year. Moreover, with all our concerns about the next several quarters, there is still, in my judgment, ample evidence that we are experiencing only a pause in the investment in a broad set of innovations that has elevated the underlying growth rate and productivity to a level significantly above that of the 2 decades preceding 1995. By all evidence, we are not yet dealing with maturing technologies that, after having sparkled for a half-decade, are now in the process of fizzling out. To the contrary, once the forces that are currently containing investment initiatives dissipate, new broadened applications of innovative technologies should again strengthen demand for capital equipment and restore solid economic growth. Thank you. I look forward to the questions of my colleagues.
Thank you very much, Mr. Chairman. Ladies and gentlemen, our club's custom is that 2 pre-selected questioners will serve this evening. We have Gail Fossler, Senior Vice President and Chief Economist at the Conference Board, and Henry Kaufman, President of Henry Kaufman and Company. Gail, I'll turn to you for the first question. Mr. Chairman.
Thank you. May I say, Mr. Chairman, that your remarks were uncharacteristically clear. My question is, you emphasized in your remarks the notion of looking at probability distributions and the movement of those risks around central tendencies. And while that is obviously something that describes the present, it also strikes me as an approach that the Fed has been using for some time. Yet, when I think back to 1995, we had much more sort of palpable evidence of decline, particularly in consumer demand. The economy looked, in some ways, alarmingly closer to recession, and yet the Fed waited for about 6 months before it cut interest rates. In the current period, the Fed has acted quickly, repeatedly, and aggressively. Could you comment on the differences between those two periods and your thinking?
It's called profits. Profit margins were holding up then, as you may recall. Productivity growth was still exhibiting acceleration. It's exceptionally difficult to envisage economic weakening in the context when those basic forces are in place. The difference between then and now is essentially in the capital goods markets. It's essentially in the issue of profits, cash flow, and the deterioration in margins that we've seen in the last year or two, and very specifically, the rise in energy prices, which we did not have at that time, and which I think we tend to underestimate as a force for impacting economic developments. The reason I say that is that we cannot in our models, and I assume, Gail, in yours either, take the type of price changes that have occurred in energy during the 3 most recent spikes and simulate a recession from that. Yet we seem to run into recessions. All of our 3 previous recessions, and I believe 3 previous oil spikes have come together. Now, clearly, that could be coincidental, and indeed, my down deep suspicion is it largely is. But it sort of gets you when you begin to see these things evolving. And who can be certain, one says, in the issue of forecasting and policy, and you tend to move in a certain direction which you might not otherwise have done. The 2 periods are really, in retrospect, and even currently, I think quite different.
Mr. Chairman, in view of the many structural changes in the economy and the financial markets which you've spoken about, what is now the time gap between an easing and a tightening of monetary policy and the impact of these actions on economic behavior?
Henry, we don't know the answer to that yet, but we are aware of the fact that it is a crucial thing that we at least get some judgment on. You're aware, as everybody, that the techniques we have for employing to get the distributive effect from policy as it impacts on the economy is a fairly sophisticated and not a wholly stable set of analyses. The one thing I would say is that whatever the pattern has been, it's faster now. And the reason I say that is that all aspects of economic development, as best I can judge, have quickened measurably owing basically to the tremendous change in the availability of crucial business decision-making information. I remember 20 years ago, the distribution of knowledge about what was going on amongst the business community was fairly widespread. There were a few sophisticated people who knew pretty much because they had their hands on, say, a multinational corporation or one sufficiently large so that their internal numbers would describe what was going on in the economy. But when you got beyond that, most people didn't know. Today, virtually all business people are reading off the same database. And as a consequence, they are behaving in a far more synchronous manner. And the consequence of that is to very substantially speed up the process. On the one hand, that clearly is desirable, but there's no question that the very process of the speed up itself is creating difficulties of policy adjustment as well as analysis. My impression essentially is that the effects of policy on the economy are still stretched out, obviously, but I suspect that the distributive lag from policy to economic response has foreshortened really quite significantly.
Mr. Chairman, let me stay with that question because I think it is maybe one of the critical differences in this period. And while I think certainly given what we have been through, it's easy to interpret your remarks in light of inventory adjustment and investment decisions, controlling costs and the like. Does that quickness and synchronicity in adjustment also apply to price increases? And could the Fed find itself in a similar situation with respect to inflation that it has with respect to growth?
Yes, no, I think, Gail, it's a very good point. I would basically say that the best way I would describe the process is to think in terms of the same economic processes we have always seen, but instead of their happening in 4 months, they happen in 3.5. And I would say that's basically true for all activities, all policy, all issues. The one difference, the one stable force which has not adjusted, and the fact that it has not is of considerable potential moment, is human response to change. We're all aware that when confronted with very extraordinary change or uncertainty, the normal human response is to disengage and pull back until you understand what is going on. It's not credible to me that with the acceleration of the technology and the decision-making process, that the human response has changed at all, which means that we are, as I indicated, I think, earlier this year, I think it was in the speech in December, I raised the issue of a confrontation of the speed up in the adjustment process against a consumer psychology which is unaltered. And it leads to the issue of, on the one hand, the speed up in the adjustment process obviously means that whatever it is that's imbalanced has a greater capability of coming back to restoration and balance sooner rather than later. But there is the risk that you can upend consumer confidence inordinately. And that is an issue which I think we do not at this stage fully understand. In other words, we know that the processes are changing. There is just no credible alternative to the fact that as we move to just-in-time inventorying and of the rapid pace of decision-making, that adjustments are going to happen far more quickly. And we know that people are going to be disturbed more. What that means fully, we do not yet know, but I can assure you is that we're going to learn a great deal more over the next 2 to 3, 4 years as a consequence of watching this phenomenon going on.
Mr. Chairman, just to follow up in a different direction a little bit, but not too much, a FET study that was inspired by you concluded that households at the top of the income and education distribution benefited disproportionately from the stock market boom in the second half of the 1990s, and that this group decreased their savings rate very sharply. Indeed, the study concluded that the well-documented decline in the economy-wide personal savings over the 1990s can be attributed almost entirely to a sharp reduction in the savings rate of families who experienced the largest capital gains. Now, in view of this, how does this affect monetary policy implications, implementation, decision-making process? And secondly, how valid are consumer sentiment surveys knowing that there is this disparity?
Well, let me just answer the second one first. it's always been very difficult to judge the state of consumer confidence and how one measures it and how it behaves in consumer markets. We tend too often to take, and you'll excuse the expression, madam, the Consumer Confidence Index as though that is consumer confidence. It is not. It is a proxy. It's an endeavor to essentially employ a series of questions which are presumed to unearth the way people think and behave and will act. The problem is we've seen more often than not, I shouldn't say more often than not, but often enough, is that we get changes in consumer confidence as measured in those indexes, and we find that retail sales go in exactly the opposite direction. Now, what that tells you, basically, is either that confidence changes before they act, which just doesn't seem credible. In other words, the presumption should be that when your confidence changes, you do something, or that's in fact the way one would assume. So you would assume, basically, that consumer confidence and retail sales moved concurrently. In fact, were highly synchronous. So it doesn't happen all the time, and we're not quite sure how to use those particular measurements. In general, so far as the savings issue is concerned, remember that what the purpose of that study was essentially to counter the question, if there is a wealth effect, which we're picking up through macroeconomic evaluations, we're sort of measuring the elements which seem to govern consumption expenditures, and what we find is holding a whole series of other variables constant. We end up with changes, for example, in stock market wealth impacting consumer expenditures approximately 3 to 5% of the total change in capital gains in a particular period of time. It was argued by a number of people that that just was not credible, that with the obvious concentration of equities in the upper income quintile, that it just was not seemingly reasonable to presume that the size of the changes in consumption expenditures that were coming off those macroeconomic analysis could be explained by stock prices. The sole purpose of this type of analysis was essentially to demonstrate that if you employed what we did, which was try to break the total household sector into 5 income quintiles, and we reproduced balance sheets for each of the quintiles, we were able to both ascertain the capital gains by quintile and the change in savings rates, and to demonstrate that indeed this apparently is what was happening, namely that all of the increase in consumption that were being picked up in a macro sense occurs only in the upper income groups. We also demonstrated that the increase in aggregate consumption, which was implicit in that, was not all that large, because remember that it's a fairly large segment of total income, and it's only a percentage point additional increase in the rate of growth. So the sole purpose of that was merely as a counter to the presumption that the macroeconomic analysis that a wealth effect existed was false. I wouldn't go terribly much beyond that, because there are a lot of other technical problems in this whole evaluation, not the least of which is the fact, as you well know, that we have reductions in disposable income and hence in savings, the way we measure it, as a consequence of increasing in taxes, both capital gains taxes and taxes on realized options, option exercise, which is a very large number and a number which has increased very substantially since 1995. We also have a problem with respect to how we measure disposable income, and indeed a significant part of the actual measured decline in the personal savings rate as it is calculated by the Department of Commerce is the result of abnormalities of the way we keep our books in a period of very significant capital gains change. And my suspicion is we do not at this stage fully understand the process, but we're going to spend a good deal of time in the period ahead to go far beyond the issue of strictly macro analysis of what the wealth effect is, to disaggregate the system in a number of different ways, to, for example, know the difference between its consumption effect of realized capital gains versus unrealized capital gains. The difference which obviously exists between personal consumption expenditure propensities out of realized gains on homes or equity extraction out of homes and stock sales or unrealized gains on equities. These all seemingly have a different propensity to spend, and it's going to matter now when it didn't previously, because as you well know, at the moment, while stock prices are going down, capital gains in homes are going up. And indeed, that is both realized capital gains in homes and unrealized. And until we get a better understanding of these different elements within the statistical structure, our full understanding, or even our better understanding, of a process which will be a major factor in economic forecasting and policy in the years ahead is not going to be fully understood.
Mr. Chairman, our final question of the evening is for Gail to take, if you would, Gail.
Well, since you mentioned taxes, there is a tax bill in Congress, and there is reports that there will be language in this tax bill providing for a direct payment of the amount of the withholding that normally would be refunded in April, essentially the tax cut that would normally have occurred between January and the enactment date, of the magnitude of about $25 billion. Do you think, A, this is advisable, B, what effect do you think it will have in terms of consumer spending in the economy, and C, is it supportive or in conflict with monetary policy?
Dick, did you say that was that the previous one was the last question, or this one? There's got to be a way to answer that question without saying anything. Let me tell you what I think we know about this issue. We do know that most of the experience we have with one-shot payments, either whether it's any large cash payment, has a remarkable similarity to other large cash payments, and that people tend on average to spend about a third or a little less than a third, which means that, for example, the rebate that we had in the spring of 1975, in the sort of when the economy was really going down fairly sharply, in retrospect also seemed to come out at about a third. On the other hand, cuts in withholding, which is a constant weekly change, seem to be very much higher, in fact, fairly close to average. So while I'm not about to respond to whether something is good or bad or even try to forecast what in fact is going to come out of the Congress, I would say that it will matter how the thing is constructed. And to respond to the question of monetary policy, I'll just respond the way I always do to questions about how other policies impact on the economy. It's basically, we would observe how it affects the economy and then respond to the economy. It's never, as our vice chairman knows, do we ever respond to fiscal policy or anything else until we can get it into a form which is evidence of how it's impacting on the overall economy. We don't act. Thank you very much, ladies and gentlemen. It's been a pleasure being here.
On behalf of the trustees, I want to thank our two excellent questioners this evening, Gail and Henry, and most importantly, I want to thank our chairman. Well into double digits will he appear before his current term has expired. Mr. Chairman, we thank you and look forward to your return.
Good question. Very well done. You're a great chairman.